Welcome back to Chapter 14. We are going to talk about promissory notes. And you may wonder what those are because we've never talked about them. So what we have talked about is accounts receivable, and we know that accounts receivable is typically collected in 10 to 15 days, maybe up to 30, 45 if things are really rough. And a lot of customers may not be able to pay within that 30 or 45 days because of some situation that's happened with their business. So they might end up asking us to, in essence, lend them that money and the product in return for some more time, which we will call a notes receivable or a promissory note. So when the business lends money to another one in writing and signed, they're going to do a promissory note. So let's look at that first slide here that has just a lot of terms on it to make sure that we understand what they are. So a written and signed promise to pay a sum of money at a specified time is a promissory note. So if they owed me $1,000, I'm going to issue this promissory note with them for $1,000 and say you now have 30 days, you have 60 days, 90, 120, however many it is. The person or business to whom the liability is owed is called a creditor, which is nothing new. We've always had that. A promissory note signed by a business and given to a creditor is entered in the business's books as a note payable. A promissory note that a business accepts from a customer is entered as a note receivable. So again, it depends on which side of the transaction we're on. Just like we had accounts receivable and accounts payable, we have notes receivable and notes payable. So whichever side of this signed promissory note document we're on, that's what it's going to be. A note payable, as you would expect, is going to have a normal credit balance, meaning it goes up as a credit, down as a debit. And a note receivable is going to have a normal debit balance because it's an asset, going up as a debit, down as a credit. Note payable liability, note receivable asset. Okay? And we do usually refer to them simply as notes. And then the maker of the note is the one who's going to pay. So promises to make the payment. So then we got a few more terms here. So the payee is the person who's going to receive payment. Receive payment is the payee. The original amount or the face amount of the note is called principal. The cost of using the funds is interest. So the percent of the principal is the interest rate. The cost again is the interest. And then the date on which the principal of the note is due to be repaid is called the maturity date. And on that date, we're going to have to pay interest and principal. And then the length of time from the date that it got signed to the maturity date, typically a number of days, is referred to as time of a note or the term. And you'll hear me usually use term. So those are kind of all the definitions behind what we're going to be doing here. Keep in mind this is all short-term in nature. That's why we're in days, because it's long-term if it's over a year, but these notes are typically considerably less than a year. So we have lots of different source documents we're aware of already, checks and receipts and memos and invoices. So a promissory note is a source document of this agreement between a borrower and a lender. And the first thing that you need to know, and you have this handout, by the way, if you just want to take notes on it. The number assigned to the note is on there, and these are sequential, of course, if we're the ones that are creating it, because we want to make sure we keep track of every single one of them. Then we have the date the note is signed. And the date the note is signed is obvious. It's the day that Stephen and Judy sat down and both signed this document. The time of the note So this is saying that it is going to be for 90 days from this date, from March 18th, that it matures. Okay, so 90 days from that date. The payee, that's who's going to get the money, receive the money, is 3 Green Products. The principal, the amount that we are letting them borrow, is $2,578.35. And the interest rate, the cost, so they have use of my funds, so I'm going to charge them 8% of the principal for having my funds and not paying me back yet. And then the maturity date is 90 days from this date on the note. And we'll learn how to calculate that, because you're going to have to do that in some of your problems, I believe. And then the maker of the note is next, and then the witness to the note. So when we accept a note receivable from a customer, this is your first journal entry that you're going to be doing. So we accept a 90-day 8% note from Skinner College for an extension of time on its account. That amount in our source document is note receivable number 6. So we have an accounts receivable, a debit of $25.78. We need to get rid of that accounts receivable because we're no longer going to collect that. And instead, we need to debit a note receivable because it now is related to a promissory note. So what I do then is on March the 18th, I debit notes receivable and I credit accounts receivable. Get rid of what they owed me and I'm extending time on, and debit the note receivable and update the ledger. So here is the transaction in the general journal, and again the source document is a note receivable. And don't forget your little slash here anytime that we're going to have to post to the general ledger and the subsidiary ledger. You want to do that. So nothing weird there. So that's our first transaction. So again, this is when they wanted an extension of time on their account, our journal entry that's in the general journal. So then, by the time they pay us, we're going to charge them interest for having use of our money. So how do we calculate interest? And hopefully some of you have done this already, but you'll see that interest is calculated by taking principal times the rate times the time is interest. So you'll see me call it party a lot. So I, interest, equals P times R times T. P times R times T. And this time is expressed as a fraction of a year. So it is a 90-day note, so we're charging them for 90 days out of 360. And you might wonder, why is it not 365? And the answer is because a lot of banks over many, many, many years have used that for simplistic purposes. Because 90 divided by 360 goes evenly. So that's what a lot of banks do, and that's what we're going to use in our textbook. But people can use 365 too, as long as we just have a method to our madness. So again, this time is as a fraction of a year, and the reason being that 8% is an annual amount, so we're looking at things from an annual perspective, and they only owe us interest for 90 days out of 360. So if we calculate that out, the interest for that 90 days is $51.57. So the amount that's due on the maturity date is called the maturity value, and the maturity value is equal to P plus I. Okay, so interest P times R times T, maturity value P plus I. So they have to pay me back the full principal they owed, as well as the interest from using my money, and I'm going to get cash then of this amount instead of the $25.78. So let's talk about how we calculate what that maturity date is, and work with me here. So you see how this works. Sorry. So it is a 90-day note. So always start with a 90-day note. And it is going to be important that you remember that knuckle thing. Remember, as we went January, February, March, April, May, June, July, August, September, October, November, December. If it's up top, it's 31 days. If it's down in the gutter, it's 30 days unless it's February. And that's important. You're going to know that. So we're starting with 90 days. We signed the note on March the 18th. So from March 18th to March 31, there's 13 days. So we take off 13 days. We got 77 left. Then the month of April had 30 days. So we're down to 47 days remaining. May has 31. We're down to 16, which means from June 1st to 16 will get us to 0, which means that is the date that it's going to mature, is on the 16th. Okay, if you need to look in the book, it'll talk you through it as well on page 427. So calculating the maturity date is important on the promissory note, so you know what day you're going to collect it. So, collecting the principal and interest on a note. So when the note reaches its maturity date, the maker of the note's got to pay the maturity value, which again is principal plus interest. And the interest earned is called interest income, which you would expect. Interest income, because it's an income account, has a normal credit balance, okay? Normal credit increases as a credit, decreases as a debit. So interest income, a revenue account. So our second transaction is collecting principal and interest on a note receivable. So on June 16th, we got the maturity value of that note. The principal was $25.78, and we got interest of this much. So we know we're getting cash for the sum of these. If we receive cash, we debit cash, and I'm going to credit interest income for that, and I'm going to credit the note receivable for that principal amount. So it's going to go in the cash receipts journal. There's the interest income, which is credited, and it's in general because we don't have an account column that's called interest income. And then the notes receivable is credited in the general credit as well for the principal. So I just make sure I know that's principal, that's interest. This is maturity value. So the sum of these two is the maturity value and our cash debit. Again, general credit here, accounts receivable, not the same as notes receivable. So that's your second transaction. Then your third transaction is we get to the maturity date, and instead of them having paid me, they dishonor it, meaning they can't pay me even when I gave them another 90 days. So they're really not okay. So Stout Company dishonors a note. It was a 60-day 8% note. Maturity value was due today. The principal was $3,000 and the interest was $40 for a total of $3,040. So what we're going to do is we're going to get rid of the note receivable for the principal amount. We're going to record the interest income because we did earn it, even though they didn't pay it. We've earned it. And then I'm going to reestablish an account receivable from them, meaning it's due right now, and we'll start to consider it for uncollectability. So most likely what's going to happen here is that I have this accounts receivable now. That note is gone. I've recorded my revenue, but this accounts receivable is going to probably get written off if they just do not have the ability to pay me because of bankruptcy or other issues. So that's really your three things in this section that you did. You first recorded the note on the date of signing the promissory note. Then you record cash receipt on the maturity date if we receive the cash, but if we don't end up receiving the cash, the third journal entry was if someone dishonored the note, and we have that here in the journal. So that is section 14.3.